You're listening to this week's episode of the Vacation Rental Business in Today's World podcast. You're about to start transforming your business and life with the information found here. We interview some of the greatest and most influential minds in the vacation short-term rental industry and supporting businesses. The information found here is a combination of brain science, transformational thinking, safety and loss prevention, and vacation short-term rental knowledge and experiences, all rolled into one to help you and your business to achieve levels you never thought possible. I am glad you are here, and now please welcome your host, Eric Thibodeau.
Good morning, everyone. Welcome back. Here with Tom Schmidt. Tom's going to talk to us, and we're going to have a little discussion today about buying vacation rentals in syndication or hedge-like type funds, something Tom and I have both done. And certainly I'll let Tom introduce himself and we'll get started.
Hey, thanks for having me back, Eric. I'm Tom Schmidt. I'm an attorney in Houston, Texas. I've been practicing law for about 25 years now. For about 20 years, I've been an active entrepreneur. I've started 13 companies, from everything from the travel industry to retail electricity to cell phone towers in Brazil, and lots of little real estate deals in between. I guess about 7 or 8 years ago, I became an active investor in other people's deals, be it real estate partnerships or companies or oil and gas partnerships, all sorts of things like that. Most recently, we've been very active in investing in pre-IPO deals, things like SpaceX, Impossible Foods, SoFi, Indigo Agriculture, et cetera, putting together groups of investors. And, obviously, if people watching are interested in that, you can reach out to us. But sort of do everything from real estate to oil and gas to space. So we cover the whole range.
The whole range. Great. Yeah. And syndication, we're going to talk about syndication. And I know you've represented some individuals with that. And I've done numerous deals as a syndicator and as a passive member. And in the last 3 years, started doing syndications with vacation rentals. So syndication sounds like a big word, but basically I view it as, hey, I'm someone who's interested in buying some real estate with some qualified investors, and I want to raise capital. And so I become what's called a syndicator. And so talk us through a little bit about that process.
Sure. So, it is a big word, and I think it's misused a lot and misunderstood a lot, even by people who engage in multiple transactions. So really what we're talking about is a guy like Tom Schmidt wants to participate in a real estate or other investment, and I don't want to take all the financial risk. I'm going to put the deal together. Depending upon what type of deal it is, I'm going to manage it, but I don't want to put all of my money in. And so I, quote unquote, syndicate the deal to others to allow them to invest. The word is used in the mortgage industry, where a bank syndicates your loan. You want to borrow $2 million, they might loan you $500,000 and get the other $1.5 million from another bank, or banks. They syndicate the deal. It happens in big corporate debt transactions. And all it really means is, in a general sense, we're not talking about technicalities, but in a general sense, it just means there's a group of people who are coming together to invest. And typically there's one party, whether that's a person or an entity, that is taking the lead on the transaction. And having said that, there's about 75 different ways you could structure a deal that is technically syndicated or shared among investors. And today we can talk kind of about different ways you can do it as it relates to a vacation rental property.
Yeah, and then we'll probably talk a lot from the individual who's leading that, but basically it's also available, like you're syndicating a deal, and I'm gonna say, Tom, I'm pretty busy, but I got a lot of cash. Can I invest in your deal? And what kind of qualifications do I have to have as that let's say, passive investor who wants to invest in your deal? or your vacation rental, your property?
Sure. So there are lots of legal issues that confront someone who's going to bring on investors. And so you want to make sure that you dot your I's and cross your T's and hire a lawyer and have a good understanding of the legal issues involved in doing this. The bottom line, and people don't really think in these terms, but the bottom line is that in the United States, it is against the law to sell securities if they are not registered with the SEC. When you say securities, that could be a promissory note. You can borrow money from your uncle for a business and give him a promissory note. You just sold him a security, and arguably you violated federal law. You could have 5 buddies get together and invest in a vacation property, and if you don't handle it correctly, you would be violating federal law by doing that. And I'm talking about going to jail type violating federal law. So that's the baseline rule. So the way that we get around it is the law provides a number of exceptions. And one of those exceptions is for what they call a Reg D, as in Delta, a Reg D offering, which is an offering that is not made public. You can't advertise it on a Google ad or on a billboard, but you can invite individuals to invest, and they have to qualify as an accredited investor. And basically that means that that person makes over a certain income per year or has more than $1 million net worth, not counting their primary residence. And there's some other intricacies in that definition. I encourage you, we have it on our tickertapeinvestments.com website, is a link to the definition, or you can just Google accredited investor. And I think Investopedia.com has a pretty good definition that explains it. But if you have a business, and a business could be a vacation rental property, it could be a piece of land, raw land, it could be a startup technology company, and you're going to bring on investors, you probably want to make sure that they qualify as an accredited investor. You can't just sell shares to anybody, otherwise you run afoul of the federal securities laws.
Yeah, so that's right. Yeah, so I invested in, I guess 2 years ago now, 4-bedroom property in Gulf Shores, Alabama, with some partners, and I syndicated the deal. I took on as the lead investor, the managing partner, and I brought in people, and I didn't register the security, but I was using the Reg D exception, all prior relationships with these individuals, and they were all accredited investors. And basically I sent them a form. They completed it, basically saying, hey, yes, I meet these qualifications. And I make it sound simple, but it really is. It's possible to be a passive investor, to provide funds to a qualified investment if it's handled properly with the right person. So I think that's this part here is that if you're potentially accredited, or you could even have a non-accredited deal structure where I could have some non-accredited people as well.
Yeah, if you follow the right rules and exceptions, yes, that's certainly possible as well. Couple of real world examples of that. If the person is not an accredited investor, but they are employed by the entity, they're actually working in the business, they're allowed to invest their money in the business. And there's other exceptions. And of course, there's the Jobs Act, which now has crowdfunding opportunities and new abilities to raise capital from smaller investors. For vacation rental properties, I wouldn't recommend doing some sort of crowdfunding deal because it has its own issues. For instance, it's one thing if you have 5 or 6 investors that you have to communicate with and deal with. Having 500 is completely different, and your phone's going to be ringing off the hook with questions and issues, and it can overwhelm you. But yeah, the easy way to do it is to just follow the Reg D exception and do an offering document that discloses the risks, and make sure that you verify that your investors are in fact qualify as accredited investors, and then from there you're good to go. But again, I feel like I should have a little red sign that I hold up every once in a while on these and says, hey, hire a lawyer. Here's one of those times you want to at least have some legal advice as to how to structure the deal and prepare your documents.
Absolutely. I've done this a number of times, and I always hire an attorney. I mean, when you think about it, the $3,000 to $10,000 that you're paying is nothing compared to the issues that you could come through with
You could face, yeah.
if you didn't. So, yeah, absolutely, I agree with you.
And if there's different situations, right? So if you're starting a business and you're going to create this one company, and then that's all you're ever going to do, and you've got to get an offering done, get the money raised, and then you're done, pay a lawyer, by all means, pay a lawyer to help you do that. In the vacation rental space, if it's a little bit different, if you're going to do a series of entities, each time you buy a property, you're going to do an entity, and you already know, hey, I'm going to do 15 of these, then go to a lawyer, pay them maybe a little bit extra for that first one, and they'll give you a set of documents that you can use cookie cutter each time. As long as the deal doesn't change in terms of structure, in terms of how much you're raising, in terms of how you're advertising the investment opportunity, you can use the same set of documents. So it's not as if you have to pay that money every time you do a vacation rental property. And that's an important point, sure.
Yeah, so syndication's a great way to raise funds, to bring people together. And let's talk about that. We talked about some of the legal issues and what's accredited and investor and how we can structure a deal. But then what's the pros of, and we can talk about cons too. What's the pros first about why would I want to form a group to purchase $1 million vacation rental property?
So yes, there's a lot of good reasons to do it. And what you want to do is you want to think out kind of what are your goals? What do you want to accomplish? What are the challenges that you have in doing the business on your own as opposed to having partners? And I can give you lots of examples from my actual life. But the number one thing that when I look at that idea, what I look at is this: listen, every person, I don't care how much you have, every person has a finite amount of cash. And, maybe you have $500,000 of cash, let's say. You got, paid a bonus or your retirement package or whatever. And with that $500,000, there's only so much you can do so fast in the vacation rental industry, right? There's always going to be a minimum of equity that has to be put into every property. And yes, you can, buy 3 properties and then sell them and get a profit and then buy 6, but that's now you're talking years and years of work. Whereas if you get 5 guys who each have $500,000 of available capital, now on day one, you've got $2.5 million of equity available, and you can accelerate the business and make it larger faster, right? And so that's the biggest thing is I call that leveraging your capital in the sense of I can now do more things, do bigger things, do things faster because I have access to more capital. Now, in my personal context, I've certainly done this on apartment deals, real estate deals, hotel deals, and vacation rentals, but where I'm doing it right now is with these pre-IPO deals, right? So I have a certain amount of cash that I'm willing to risk of my own money in, let's say, things like SpaceX, Impossible Foods, Palantir, some of these hot stocks and stuff you've heard about. So I could invest in 3 of them, divide my cash among 3 and be fine. And then that way I can meet the minimum investment. I could get the best price, whatever. But what I've done instead is I've syndicated each of those deals. So, we did a SpaceX deal. And if I invested more money in the deal, I got a better price on the shares. So instead of me coming out of my pocket for all that money, I said, hey, let's bring 10 friends. You guys all throw in money. Somebody puts in 10 grand, somebody puts in 50 grand. We all get together, we create an LLC, and we do the deal. Same exact thing you could do for a vacation rental property. We want to buy this house. It costs $1 million. The bank wants us to put up, or we want to put up 400,000 of equity and borrow 600,000 because we don't want to be over leveraged. Okay, great. I'm the lead guy. I'll put in 50 grand and I'll go to my friends and contacts and say, hey, who's in, and raise 350,000 from someone else. I get some sort of preferred return. We can talk about that in more detail for having found the deal, vetted the deal, managing the deal, all those things. But the other guys get the benefit of my work. And that's really the second big benefit. So the first is you're leveraging your cash. You're buying more assets with the same cash. The second is leveraging your time, right? I can manage, Eric, can manage a handful of properties, but at some point it gets to be too many. But you know what you can do? Let's say you can manage 6 and you own those 6 and you're the lead investor on those 6, but you can invest in me and my group, and now you're invested in 12. And then you invest in another guy, now you're invested in 18. You can't run 18 on your own, but you can have the economic value. And so it allows you to leverage your time. And so that's another thing I do. But I want to say this because in any topic I talk about in investing, this always comes up, whether it's about Tesla and a publicly traded stock or an apartment complex or an oil and gas deal, whatever. The most important thing in any sophisticated investment advisory firm will tell you this is diversification. So what I've seen a million times is a guy works in the oil and gas industry in exploration and production, and everything he knows is in that industry. And so guess what? That's what he invests in. And you look at his portfolio, and 90% of his net worth is in oil and gas. Not okay. If you're going to do that, if you're going to be 90% in one industry, make sure you're in 10, 12, 15 different deals. Maybe you've got an investment in a oil transportation company. Maybe you've got an investment in some leasing rights. Maybe you've got a production lease, but get that diversification. So even for me, part of the reason I syndicate these pre-IPO deals is so that I can have my assets in more deals, right? Same thing with vacation rentals. Don't put all your money in one, sorry to make fun of you, but one 12-bedroom house on the Gulf Coast, because if that 12-bedroom house gets knocked down by a hurricane, all of a sudden you got a problem. It would be better to buy 10 smaller houses, particularly in different geographic locations, with maybe some of them in, say, Maine or Vermont or with Montana, so that their seasonality is offset. Get that diversification, and over the long term, you'll get a lot of benefit out of that. So, man, I get it. It's hard to manage a cluster of properties on the Gulf Coast and at the same time look at Lake Tahoe or Seattle, Vancouver, or something like that. Invest in someone else's deal and get that diversification while leveraging your cash and your time.
Yeah, I call it going further faster.
Right.
Exactly. That's exactly what you've done. And, I've invested in 27 some different companies, some of which Tom is the lead on. And that's exactly what I'm doing, going further faster. And, another aspect I like about it is that, I guess 8 years ago, I invested in a property, an apartment complex, and we sold it last year. I never went there. I read the emails each month. I looked at the statements, and basically I made $500,000. And so I'm not saying that's the same type of performance you'll get all the time, but I mean, the aspect of this is that, you pick a deal and you don't have to be involved day to day or
it leverages your time.
It leverages your time. And basically, it's a great return over that period of time. So I think those are good advantages of, using a syndication. We could probably talk, at length about it, about the pros, but I mean, it's a way to move your money faster, not have to be involved, be passive. And then if you are the one who's putting together the deal, there's certainly advantages for you. What are some of those advantages if you are the one putting together that investment deal?
Well, what's the phrase? Other people's money, right? So you're going to be making money for yourself, partly based on your own cash, but partly based on the value that is brought by the other people's investments. And so that's really what it's about. And it's about, and by the way, there's different ways to structure these deals and different strategies, I guess. For instance, you mentioned at the beginning of this call the idea of a fund. So, that's something you could do. You could say, hey, listen, I'm raising a fund. We're going to raise $10 million from investors. And once we get the $10 million, we're going to deploy it by investing in vacation rental properties, and we have a management structure to manage them. That's one way you could do it. Another way you could do it is say, I'm buying that property right there. Here's my contract to purchase it for $1 million. I need $400,000. We're investing in this one property. And, then the investor, if you're assuming you're going to go buy 10 or 15 properties, the investor can choose which ones they're in, which ones they're not. I do this with a hotel group, and Eric, you're partly invested through Ticker Tape 2 in one of their deals in Carolina. But what they do is they go out and they buy or build hotels. And each time they have a project, they bring it to me. Hey, Tom, do you want to invest? And I might say, no, I don't like that one. I do like this one. And so it allows me as the outside investor to choose the ones I participate in. And so I like that structure. Same thing with my pre-IPO deals, rather than doing a fund and doing lots of them in that fund where Eric invests in the fund, but then he doesn't like SpaceX. He thinks that's going to take too long for that one to pay off. So he doesn't want to invest in it, but he's forced to because he's part of the fund, right? So, but if we do them individually, then Eric can say, you know what, I'm going to put $25,000 in Ripple because I think that's high risk, but I'm going to put $100,000 in the surgery center deal, and I'm going to put $250,000 in SpaceX because I think that's the future of the universe. And so you can kind of vote with your dollars and allocate your assets across that portfolio. And investors like that. And one of the things that we find, because, I don't know, I guess we haven't talked about this a lot, but through Ticker Tape Investments, Rita Carpel and I raise money for all kinds of deals. We just did a surgery center deal that liquidated where we weren't even expecting to get our money back so fast, but we did. Surgery centers, hotels, real estate, vacation, whatever it is. Travel industry, et cetera. But one of the things that we find is that different investors, different human beings like different deals, right? So we did this surgery center deal that was primarily a dividend paying investment, expecting to get a 13% annual return, and a different group of people invested in that deal than they did in the SpaceX deal. And the same thing is true in vacation rentals. You're going to have different folks invest in an Aspen deal than you are a Fredericksburg, Texas deal or a Gulf Shores vacation. You have different investors with a different interest level in different geographies. And so doing them individually, to me, makes a lot of sense. Now, if you want to get much more sophisticated, much higher level performance, go raise a fund of $10 million and use the funds in a combination of your own properties that you're managing as well as passive investments in other people's deals.
Yeah, certainly I've done the former is just picking a property and buying it and with partners. The fund idea is certainly one that I'm intrigued by, and certainly it's you're raising funds and say, okay, I'm going to raise $10 million to go buy this. And where are you looking at? I don't know. I can't tell you a property, but I can tell you what I'm looking for and what I'm looking for. And then, once you get investors looking at that, it does pretty good. One of the other presenters, Tony Keppert, he basically created a fund, and Tommy, he has another presentation, but I mean, he's making, him and investors are making 24% a year, cash on cash. I mean, who's going to say no to that?
Right.
I mean, so I think there's advantages to the fund. It's a little more open-ended, if you will, but certainly having the right parameters to do it is great. Either way, you need the right legal entity structure and the right securities documents to register or to get the exemptions.
Yep, absolutely.
Yeah. So, well, great. Anything else we did? I mean, this is like a whole day session on this whole topic. We're just scratching the surface,
right? And we have time limitations. Obviously, reach out to Eric or to me, and we're happy to answer questions for you about specific ideas, structures. You can bounce ideas off us or whatever. Happy to do that. We should probably take a couple minutes and talk about some of the concerns and cons of syndicating deals. And I, at the end of the day, I'm a big proponent of partnering with other people, and I can't overstate the value of leveraging your time, right? Because Eric, when you go out to do your next deal and you already know, hey, I'm going to get Schmidt and some other guys to come invest in this, you're taking the time to go out and find the property. You're going out and walking the ground, right? And you use the example of the apartment complex investment where you made a bunch of money. You never set foot there, right? You didn't have to check out the roof or the foundation or vet the tenants to make sure they were going to pay the rents on time, because you didn't have time to do that. You were off doing something else. And that's what the syndication allows for the investors. And it allows you as the principal of deal number one, you can be a passive in deal number two. But you're going to lose control. You're not going to be able to make every decision you want to make, because you're going to have to watch out for the investors and make decisions in their best interest. You owe them a fiduciary duty if you're operating on their behalf. You're going to have some headaches, right? If something goes wrong, man, your phone's going to be ringing off the hook, and you're going to have to answer the questions of those people. Rita and I took on 10 new investors that hadn't invested with us before in this surgery center deal. And they happen to be a very noisy group of investors. And all of a sudden we're answering text messages at 2:00 in the morning because these guys all want to know what's going on. Hey, did my paper get in? Did my money get what? And it can drive you crazy. So you got to be prepared for that. You'll have a crazy investor. I remember we had a deal where I had shareholders in multiple states. And so our shareholder meeting had to be on a conference call. And one of the guys said, hey, all you guys on the East Coast, if you see a mushroom cloud forming on the western horizon, that's me setting off a nuclear device on Tom Schmidt's house. I was like, and here's a guy that I'd allowed to invest in the company, and turns out he was nuts and wanted to do nothing but cause problems. Well, you got that's going to happen to you, as soon as you start taking other people's money. So be aware of those challenges. Talk to a lawyer, an advisor, somebody like Ticker Tape Investments that puts deals together all the time, and they can give you advice and give you a heads up on those types of things that you got to watch out for.
Yeah, you're exactly right. I mean, sometimes people you let your deals are they're a lot of work, but once they're in, we appreciate all our investors and provide them the right fiduciary responsibility, provide them all the information that we're receiving, that they're getting. So I do think that's important. And, just along with that, if you're looking at investing in a property through a syndication, I always look, and it's been my experience, is that I don't have to see the property as long as I know the person who's putting it together. Right. So it's like, do I invest in the horse or the jockey?
Sorry to interrupt you, but I don't recommend that. As a lawyer, I'd say you need to go see the property, but obviously you got lucky in that one.
Yeah. Okay. So yeah. So that's good advice. I tend to, I don't mind looking at the property, and I look at the numbers.
Right. Sure.
But I look at the quality and the integrity of the person who's bringing the deal forward and how they're going to run it.
Absolutely.
That to me that's key in doing this. So
conduct your due diligence. I once charged a client over $500,000 in legal fees fighting a lawsuit where he bought a business and lost all his money and sued the seller. And the facts were that when the seller sold him the business, they delivered 3 boxes of records about the company, and my client never opened the boxes, never opened them. Didn't do any due diligence, just said, I think it's going to be a great business. I'm going to do this, that, and the other. Doesn't matter what the other guy did. And of course, he lost all his money. And he ended up having to pay me $500,000 to go fight a lawsuit to try to get some of his money back. And at the end of the day, if he had done the due diligence, he wouldn't have done the deal. So that's my example. Do your due diligence, investigate, spend a little bit of time doing that. It'll save you tens of thousands, if not hundreds of thousands of dollars at the end of the day.
Yeah, I agree 100%. Due diligence in anything you're doing is worth it, particularly in investing and looking at the people running the investment. So,
right.
Great. Anything else, Tom?
I think that covers it. But, if you have specific questions, obviously, you know how to reach out to Eric or to me, tickertapeinvestments.com, or if you have legal questions, schmidtfirm.com.
Great. We appreciate it. I think this is interesting to bring this topic of how we're investing in vacation rentals in today's world. It's taking some of the things we've learned and investing in other parts of businesses and saying, you know what, we can do this in vacation rentals as well.
Absolutely.
And
Absolutely.
It's something to bring to the audience to consider. So, Tom, I appreciate your advice and your experience in syndication and funds for vacation rentals.
hey, listen, the pleasure's mine, Eric. I appreciate you're doing this for educating folks getting into this industry. I think it's incredibly valuable, and I encourage all you guys watching this video to watch the others as well. I think this is incredibly valuable. It's sort of a jump start on things you probably didn't think about in the vacation rental market.
Great. Thanks, Tom. Have a great day.
Thank you.
Appreciate it.
Take care.
Thank you for listening to Safer VR's podcast with Eric Thibodeau. If you enjoy this, I would love you to join my Facebook group, The Safer Vacation Rentals, for more of the same. You can also join our email list at www.safervrs.com.